Welcome to FX Smart. We're delighted to have you with us. In today's episode, we'll be diving into the world of advanced chart patterns in price action trading, specifically tailored for smart money concepts. If these patterns haven't brought you success yet, it might be due to incorrect usage. But don't worry, we're here to help you turn that around. We'll showcase the most effective chart patterns, explore the psychology behind them, and offer a detailed, rules-based guide to enhance your trading strategy. If you enjoy this content, please hit the like button and subscribe if you're new here. Let's get started. What are rising and falling wedge patterns? Let's begin with the rising and falling wedge patterns. A wedge pattern signifies a consolidation phase where the price moves within a narrowing structure formed by two converging trend lines. This pattern reflects a market struggling for direction, with buyers and sellers battling for control. Each time the price nears the upper trend line, sellers step in and drive it lower. Conversely, when the price hits the lower trend line, buyers push it higher. Thus, a breakout above or below these trend lines signals which side has gained dominance. A breakout above a falling wedge in an uptrend suggests a continuation to the upside, while a breakdown below a rising wedge in a downtrend indicates a further move to the downside. In terms of market direction, we can identify four types of wedge patterns on the chart. However, in this video, we'll focus on the falling wedge in a bullish market and the rising wedge in a bearish market. This focus is because trading these two patterns aligns with the dominant trend, making our trades more effective and logical. Falling wedge pattern in the bull market. This pattern indicates a period of correction in a bull market, characterized by a clear upward trend. How can we leverage this pattern to enter the market? When the price breaks above the falling wedge in an uptrend, it signals the continuation of the upward movement. This indicates that buyers have gained the upper hand over sellers, allowing the price to continue its ascent. However, sometimes these breakouts are false, leading to confusion as the price reverts back into the range after briefly breaking the upper trend line, trapping traders who entered long positions prematurely. So how can we identify true breakouts? Here are some tips to enhance the effectiveness of wedge patterns. 1. Proper trend line drawing. Draw trend lines from the wicks in areas with the maximum number of touches to accurately identify the rejection area. 2. Clear break and close, wait for a candle to definitively break and close above the trend line for initial confirmation. 3. Confirm market momentum. Ensure the price also breaks above the previous market structure to confirm that the market has sufficient momentum to push higher. Once the break is confirmed, look for entry signals to open a buy position. Sometimes, entering immediately after the breakout might result in a large stop loss if placed below the swing low. To get a better entry price, wait for a pullback. Ideal entry points can be rejections at the back of the trend line, the 61.8% Fibonacci retracement level, or a recognized demand area. These points offer better opportunities to enter a long position with a more favorable risk-reward ratio. Rising wedge pattern in the bear market. This pattern indicates a period of correction in a bear market with a clear downtrend. When the price breaks below the rising wedge in a downtrend, it signals the continuation of the downward movement. This indicates that sellers have gained control over buyers, allowing the price to continue its decline. To confirm this breakout, we wait for a candle to clearly break and close below the trend line. Additionally, the price should break below the previous market structure to ensure enough momentum for further downside movement. Once these conditions are met, we will look for short opportunities aligned with the dominant downtrend. On the XAUUSD 1-hour chart, we observe a strong bearish trend. On the left-hand side, we can spot a fair value gap, indicating a significant supply zone. The market has already reacted to this area, presenting a good shorting opportunity. To increase our confidence, let's zoom into a lower time frame for additional confirmation. Switching to the 15-minute chart, we see a wedge pattern, which represents a corrective phase within the larger downtrend. There was a false breakout to the upside, but the price quickly reverted back into the range. To enter a short position, we need the price to break below the lower trend line and the previous market structure, confirming that sellers have regained control. Opening a short position immediately would result in a large stop loss, as it needs to be placed above the recent swing high. Therefore, we should wait for a pullback to enter at a more favorable price. Using the Fibonacci retracement tool, we measure from the start to the end of the latest impulsive move and set a sell limit at the 61.8% retracement level. Our stop loss will be placed above the swing high, aiming for a solid risk to reward ratio of 1:2. On the gold 1-hour chart, we observe a clear uptrend. The market has made a pullback, and now we need to identify a demand area to enter a long position. Similar to the previous example, we can see a small fair value gap on the left-hand side, which has already been rejected by the price. Zooming into the 15-minute chart for further confirmation, we identify a wedge pattern that has broken to the upside, precisely after the market tapped into the 1-hour fair value gap. Additionally, there is a liquidity pattern that has swept the stop losses below the equal lows. With a clear breakout in place, we can open a long position and set our stop loss below the swing low. If you're looking for a reliable and reputable broker with a proven track record, Hankotrade is your best choice. This broker has been active in the financial markets for many years. Let's take a look at the Hankotrade online platform. This platform will astonish you. You have access to a wide range of indicators and all the analytical tools you need. One of the remarkable features of this platform is its amazing indicators. You can add any number of indicators to your charts without any limitations. If you want to check important news and reports, you can easily access them here without having to scour other websites for market news and report release times. You can conveniently set up multiple alerts on various symbols and not worry about missing opportunities. Access to your account is easy, allowing you to manage your positions effortlessly. You can use this platform on both mobile and Windows devices. It's an amazing platform with a plethora of features and incredible tools. Don't miss out on this opportunity. Join this broker today and enjoy trading. I've provided the registration link in the description. How to trade double top and double bottom. A double top or double bottom is a widely recognized M-shaped reversal pattern in price action trading. This pattern occurs when the price is rejected twice from a specific area. When this pattern forms, it indicates that the price failed to create a new lower low, possibly due to factors such as momentum loss, market structure shifts, or interaction with a higher time frame key level. As a result, the price may either reverse or enter a temporary correction phase. The significance of this pattern lies in its versatility, as it can be used in conjunction with various trading concepts as an entry trigger, which we will explore later. So how should we approach the market when this pattern appears? The most conservative method is to wait for the price to break the neckline, confirming the reversal. However, entering after the neckline break often results in a large stop loss. A more common strategy is to wait for the price to pull back to the neckline and look for candlestick rejections to enter trades. The downside is that we might miss the trade if a suitable candlestick formation doesn't occur. An alternative approach is to combine the double top or bottom with the 61.8 Fibonacci retracement level to optimize trade entries. After the neckline break, we apply the retracement tool from the start of the move to the end of the recent move and place a buy limit order at the 61.8 retracement level. For a bearish scenario, where the price rejects a level twice and breaks above the neckline, we use the Fibonacci retracement tool and place sell limits at the 61.8 retracement level. Our stop loss is set below the swing low, targeting the next market structure level. However, an important point to consider is that trading every double top and bottom in isolation is not effective. The most effective way to trade this pattern is by combining it with smart money concepts. When this reversal pattern forms within an SMC supply or demand area, it serves as a strong confirmation for entering a trade, especially if the second rejection acts as a liquidity sweep. On the XAUUSD 1-hour chart, we observe a clear downtrend. To find short opportunities, we mark the previous bullish candles as the area of supply. Given the large supply zone, we need to zoom into lower time frames for better entry confirmations. First, we wait for the price to tap into the supply zone, Then switch to the 5-minute chart for closer analysis. On the 5-minute chart, we notice the market forming a double top reversal pattern, indicating momentum loss. This increases the likelihood of the price continuing to move lower in line with the higher timeframe trend. However, entering the market immediately would result in a large stop loss. Therefore, we wait for the price to pull back to the neckline and look for signs of rejection. In this case, the price pulls back to the neckline and forms a bearish engulfing candlestick, providing our entry signal for a short position. Our stop loss is set above the swing high, aiming for a solid risk to reward ratio of 1:2. Ascending and descending triangles. This pattern can indicate both trend continuation and reversal. It is unique due to the psychology behind it. In an ascending triangle, there are multiple rejections from a resistance area, but on the downside, a bullish trend line pushes the price upward, creating higher lows with equal highs. Psychology behind the ascending triangle. Although the price seems unable to break the resistance, buyers enter the market earlier each time the price drops, showing their growing strength. A break above the resistance indicates that buyers have finally managed a breakout, allowing the price to push upwards in line with the dominant uptrend. However, if this pattern appears after a prolonged uptrend, it might signal exhaustion as buyers fail to break the resistance despite multiple attempts. A break below the trend line then suggests a possible reversal. Confirmation requires the price to break below the previous market structure, indicating sufficient momentum for a downward push. We look for entry reasons to open a sell position after this break, but waiting for a pullback might be necessary to avoid a large stop loss. Descending triangle pattern analysis. Similarly, the descending triangle typically signals bearish continuation but can also indicate a reversal. The price faces rejections from a support area, while a bearish trend line creates lower highs. A break below the support shows that sellers have gained control, pushing the price downwards. To avoid a fake breakout or liquidity sweep, it's prudent to wait for a clear breakout followed by a pullback and rejection at the former support, now turned resistance. If the descending triangle forms after a prolonged downtrend, it might indicate that sellers are exhausted. A break above the trend line could signal a potential reversal, requiring the price to break above the previous market structure for confirmation. On the gold 15-minute chart, a descending triangle pattern appears during a downtrend. The price is trapped between the trend line and support area, indicating a battle between buyers and sellers. A clear break below the support signals bearish momentum and continuation. After the break, the former support turns into resistance, offering a short trading opportunity. The entry reason for opening a short position is a bearish engulfing candlestick, providing further confirmation. The stop loss is set above the engulfing candle, aiming for a 1:2 risk to reward ratio. On the dollar-yen 15-minute chart, a descending triangle pattern forms. Initially, the price breaks the trend line to the upside, suggesting a potential reversal as buyers overcome sellers. However, true confirmation requires the price to break above strong resistance. Instead, the price action reveals a fake breakout, with the price breaking the support area to the downside and continuing the dominant downtrend. That's it for this video. I hope you found this explanation valuable. If you did, please support us by hitting the like button. If you're new here, consider subscribing to our channel. See you in the next episode.